Welcome back everyone. Today we're going to explore a wonderful and powerful metric known as the Treynor Ratio. Even if you are totally new to investing, by the end of this video you'll have a crystal clear understanding of how this simple number can help you clearly see if your investments are properly rewarding you for the risks you take related to the overall market movements. Have you ever wondered if the risks you are taking with your investments are truly worth the reward? Now, many investors ignore how their investments react to overall market changes. But what if you could easily measure if your portfolio is actually compensating you fairly for the risks tied directly to the market itself? Now, that's exactly what the Treynor Ratio does. So stick around and let's uncover this investment secret together. The Treynor Ratio was created by Jack Treynor, a famous economist. It measures how well an investment compensates you for what's called market risk or systematic risk. Simply put, the Treynor Ratio tells you how much extra return you're getting for the risks that you're taking that's directly tied to the broader market. Now, market risk, also called systematic risk, is the risk your investments losing value due to the changes or movements in the entire market. Think of events like economic recessions, political instability, or major economic shifts. No matter how well you diversify your investments, you can't completely escape market risk. It's always present. Now, how do we calculate the Treynor Ratio? It's a quite simple formula and it goes like this. The Treynor Ratio is the portfolio return minus the risk-free rate divided by the beta. The portfolio return is the average return of your entire portfolio over a specific period. The risk-free rate is the return you'd expect from an investment with absolutely no risk of losing money. Typically, investors use government bonds like US Treasury bills as their benchmark for this rate because they're backed by the government and considered extremely safe. For instance, if the government bonds give you a 2% return, that 2% becomes your risk-free rate. And then we have the beta. Now, beta is a measure of how much your investment or portfolio moves relative to the overall market. And what do we mean by market? Well, when we say the market, think of this as a large basket of companies represented by indexes, like the Standard & Poor's 500, Nasdaq, or the top 50 cryptocurrencies. Investors use these indexes to see how their investment performed compared to the overall economy of a specific industry. Here's another simple way to understand it. If your investment has a beta of exactly 1, it moves exactly with the market. So if the market goes up by 10%, your investment also rises by 10%. If the beta is greater than 1, then your investment moves more than the market. A beta of 1.5 means that if the market rises 10%, your investment rises about 15%. But it also means that if the market falls by 10%, your investment also falls by about 15%. A beta less than 1 means that your investment moves less than the market. It's less risky compared to the market fluctuations. Now, beta is usually calculated using historical investment and market data, comparing of how your investment's returns move relative to the market returns. Let's illustrate this with 2 examples. Here's Alice. Her portfolio has a return of 12%. Her risk-free rate has 2%. And her beta is 1.2, so in other words she has more market risk. Now the calculation for the Treynor Ratio of Alice's portfolio is as follows. 12 minus 2% divided by 1.2 equals 8.33. Now here's Bob's portfolio. He has a return of 9%, his risk-free rate is also 2%, but his beta is 0.8, which means that he has less market risk. Now the calculation for his Treynor Ratio is 9 minus 2 divided by 0.8 and he has a Treynor Ratio of 8.75. Even though Alice has a higher return, Bob's portfolio has a higher Treynor Ratio, meaning that Bob got better compensation for each unit of market risk he took. Alice has a higher market risk since her beta is higher. So the main key takeaways of using the Treynor Ratio are as follows. The Treynor Ratio helps investors clearly identify if the risks they are taking are justified by their returns, relative to the market movements of course. It's particularly useful when comparing portfolios or investments, especially those focused on market exposure. And investors can see if they're earning enough extra returns for taking on additional market-related risks, helping them make safer, smarter choices. If this explanation helped clarify how market risk and returns relate, then please hit the like button and subscribe for more easy to understand investment insights. Become a patron if you want to support me and motivate me to make more videos in the future. And I have also written an ebook that contains more information about algorithmic trading, and it contains a whole chapter on how to analyze your results and determine the best trading strategy for you. Now, if you're curious about more investment ratios and how to use them, then check my playlist and watch out for future videos. Thanks for watching, and I'll see you in the next video. Goodbye!